First, let's understand what happens when you underreport your revenue. You're not only cheating on taxes, but you're shooting yourself in the foot when it's time to sell your business. Watch this video to find out why and how it really affects your business valuation. Hi, I'm Trent Lee. I've sold over 600 businesses, and for the last 5 years in a row, I've been named the #1 business broker in the country for the most closed transactions per year, and I make these videos so that one day, when you're ready to sell your business, you'll think about hiring me. Valuation factors are the cornerstone of determining the worth of your business. These factors typically include key financial metrics such as revenue, profit, and cash flow. When you engage in the practice of underreporting your revenue, you're essentially diminishing the perceived and real value of your business on paper. This not only affects the overall assessment of your company's financial health, but it directly impacts the attractiveness to potential buyers. By undermining the accuracy of these crucial metrics, you risk undervaluing your business, potentially leading to a lower sales price and a less favorable deal when the time comes to sell. Accurate financial reporting is essential to ensure that your business gets a fair market value it rightfully deserves in the eyes of the buyer. Buyer trust is paramount when it comes to selling your business. Prospective buyers heavily depend on your financial records to assess the health and the viability of your business. However, when underreporting revenue becomes a practice, it directly undermines the trust. Buyers become skeptical about the accuracy and integrity of your financials, which can significantly hinder the sales process. Eroding buyer trust can lead to prolonged negotiations, increased scrutiny, and even the loss of potential buyers who are wary of investing in a business with questionable financial transparency. Maintaining the highest level of trust through accurate financial reporting is crucial for attracting serious, qualified buyers who are likely to proceed with the sale and offer a fair market price for your business. Allow me to illustrate the consequences of underreporting revenue with a real-life example. This will demonstrate the significant financial implications. I once facilitated a sale of a business where the owners chose to hide $25,000 in expenses related to an all-expense trip to Disneyland. I guess Disney has an island in Hawaii. They took their whole family. The problem is they wrote it off in their cost of goods. They operated their business as an S corporation, which meant the net profit would flow to their personal tax bracket at a tax rate of 25%. At the time of the valuation, we assessed the business using a 3x multiple. Now let's dive into the mathematics to unveil the true impact of this decision and what it did to their business valuation, not to mention that it was dishonest to begin with. By employing this deceptive strategy, they managed to save 25% in taxes on the $25,000, equating to $6,250. However, the apparent tax savings killed their business valuation. By concealing $25,000 in profit using a 3x multiple, they lost $75,000 in valuation. This stark contrast, by the way, a real-life example, illustrates that while the decision saved them $6,250 in taxes, it ultimately cost them a staggering $75,000 in valuation on the sales price. This real-world example underscores the critical importance of, one, being honest and accurate in your financial reporting when it comes to selling your business and its consequences, but it ultimately erodes the buyer's trust. If you lie on your tax returns, what else are you lying about in the business? Underreporting on taxes can create a daunting challenge for both buyers and bankers when it comes to advising their clients on the due diligence process. For buyers, discovering discrepancies in the financial records due to underreporting raises red flags and creates uncertainty about the true financial health of the business. It erodes trust and makes them hesitant to proceed with the transaction, as they fear the unknown. On the other hand, bankers responsible for evaluating the viability of a loan or financing may find it challenging to provide favorable terms or recommend a client proceed at all when the financials are underreported. In both cases, underreporting on taxes can lead to extended negotiations, increased scrutiny, and even jeopardize the entire sale, highlighting the critical importance of transparent and accurate financial reporting and facilitating smooth and trustworthy business transactions cannot be overstated. In conclusion, underreporting revenue is not just a financial shortcut, it's fundamentally dishonest and can have severe consequences for small business owners at the moment when they should be striving to maximize their valuation. It erodes too much trust and jeopardizes the transaction, not to mention it kills the valuation. So, when preparing to sell a small business, honesty and transparency, just like we all learned when we were young, is always the best policy. By providing accurate and complete financial information, sellers can attract potential and serious buyers and negotiate from a position of strength and secure the true fair market value of their business. In the long run, integrity proves to be the wisest strategy when seeking the best business outcome. If you enjoyed this video, be sure to like and subscribe to see more videos about how to prepare and sell your business. I look forward to working with you. Thanks.